great to have you here at the
Morning.
desk with us. So talk to us just about why you're a bit more optimistic, at least when it comes to growth here in the U.S.
Yeah, the U.S. is really outperforming the rest of the advanced countries. So last year, on average, growth in those countries fell by 2.5 percentage points, actually picked up in the U.S. So we're seeing a boost in productivity. We're also seeing a boost in investment. So the Inflation Reduction Act, which is the government's kind of energy transition push, is crowding in private investment. So all this is kind of lifting the growth profile in the U.S. On top of that, you get strong services and labor market, and we're going to have another year of 2.5% growth this year, it looks like.
What does that do for the view on policy rates from your perspective as well?
Yeah, well, we've always been in the kind of higher for longer camp, and now it's a slower for longer camp. The markets, as we know, keep kind of pushing and hoping that it happens faster. At one point, I think the market had 6 rate cuts priced in for this year. Powell's been very clear. Christine Lagarde at the ECB has been very clear. They're going to be patient and make sure that we're down on a path toward 2. We think the Fed goes with the first cut around the middle of the year, maybe 3 cuts this year. But I think what's emerging is that they may not go as far as we've been thinking, because the neutral rate, kind of the ultimate landing rate, may have gone up. Pre-COVID in the U.S., that was 2.5. Now we think it's closer to 3. And then in Europe, it was 1.5. Now it's 2.5. So this kind of global interest rate, or the global equilibrium interest rate, if you will, has ratcheted up.
So then what does that tell us for cuts then in 2025?
Yeah, well, we get 3 this year and maybe 5 next year. But if we kind of land 3-ish, then we're close to done. Unless if the labor market tanks, that's the downside scenario. Then the Fed has a lot of space to cut now. They would do that. But in the baseline, it's going to be gradual and, as we get inflation back to 2.
And there would have to be a reason for 5 cuts to come next year as well. What is the severity of perhaps some of the impact to the economy that you're anticipating in that 5-cut call for 2025?
Right. Well, the U.S. has to slow down, right? If you think this is a 2% economy and we got to take a little bit of demand pressure out to get inflation down to the 2% target, we're not going below 2, right? Last year, every quarter printed above 2. Looks like Q1's going to print above 2. So at some point, and this is actually our forecast, second half of this year, we've got to slow down a bit. The Fed doesn't have to wait for inflation to get to 2 to start cutting, right? So financial conditions are relatively tight now. When they've got the clear path to 2, then they're going to start gradually, taking the tightness out of the system.
Well, why do you think it's been so tough to get inflation under control? We talk about that last mile flight. Maybe it is higher than what the Fed's target is, just around 2% here. We talk about all the changes that have happened within the economy. But why has it been as sticky as it has been up until this point?
It's a little bit of a mystery, right? If you told, well, by the way, the Fed moved off of 0 about 2 years ago on St. Patrick's Day in 2022, and then they haven't moved since last May, right? So it's really been the labor market. The labor market's a big surprise. If you asked most economists 2 years ago, where would we be if the Fed went, 525 basis points off of 0? No one would be calling for a 3.9% unemployment rate and a growth above 2 for the whole year. So we've just had this resilience, which is surprising and good in a way, right? We've still got something close to full employment, but that's what's been so tough. It's the core services inflation that's really the issue here.
What's the core knock to that resiliency, the key that you're tracking to see whether or not consumers do start to show larger cracks?
We're watching the labor market very, very closely, right? And particularly the services. That's the key to the whole story.
S&P Global's Paul Gruenwald. Paul, great to see you here in studio with us.
My pleasure, guys.